partially amortized means that you're actually paying an artificially low payment. Usually these loans are for a shorter period of time, and they tend to be in the commercial real estate field, although they do exist in residential, but they're quite rare currently because interest rates are so low. So basically it's like one of these things where you're paying an artificially low payment, and then at the end of the mortgage you still have principal to pay off, which we call a balloon payment. And it's like so large, it's like staggering. Nobody could really pay it. That's why you got the loan to begin with. And if you take something like in commercial real estate, like the example I give in class, like you buy a piece of land and then you make it to a shopping plaza, your relative value has gone up, so you'll be able to sell it or refi. Because you never want to really take one of those balloon payment mortgages, or sometimes known as a partially amortized, all the way to term, because then you have this giant payment at the end. Temporary holding, that's a good way to think about it, right? And the really bad reason why you don't want to have that in a single family home is because you never really add any relative value. Unless you can get out of it, if interest rates are 19% when you get it, and then you're smart enough in the timing and everything, and you refi when rates drop to 11, then you win, right? So there's also the idea that as the years go by, with inflation, those dollars have less value, which is somewhat of a hard concept for us to think about now because inflation is so low currently. But, when I was a kid in the late 70s, early 80s, inflation was horrific.